Welcome back to the Wealth Blueprint Brick by Brick, featuring your hosts from the Sapphire Group, Jessica and Marissa. So Marissa, who do we have today?
Today we are so excited because we have one of our favorite guests here today. He is a real estate broker and investor. He goes by Daniel Foch, and he is the co-host of the Canadian Real Estate Investor podcast, which is the #1 Canadian podcast. And Dan, how are you today? We're so excited to have you.
I'm good. Yeah, I'm very good. The legislative world, politicians make it really easy for us to create content in this space. There's always something changing. So yeah, no complaints on my end. How about you?
Yeah, we're good too. Yeah, I know every time you think you get a little bit comfortable, the government throws something at you. You have to stay quick on your toes for sure.
Absolutely. Yeah.
So
Yeah,
we're really excited to have you today. We listen to your podcast for sure. And, we always get up-to-date information on your Instagram. So we want to get straight into it because we do have a short amount of time and you're a wealth of knowledge. So we want to start with OSFI just removed the stress test for, bouncing from one lender to another. What is your take on what's the kind of good, bad, and ugly with that?
I think it's good because it should improve competition a little bit in this space. Like previously on renewal, you would have been, well, especially up against a huge rate increase environment, which we're about to see. Like everybody who's renewing next year will be renewing from like a 2% rate to a 4.5%, 5% rate. And so they, in most cases, wouldn't really be able to shop that renewal around because they probably would have a hard time requalifying with another lender. And so removing the stress test levels the playing field between different lenders and makes it so that people can shop around a little bit on renewal. This was already the case for insured mortgages. So insured mortgages, there was no stress test on renewal. OSFI clarified that in a statement that they put out early 2023. So I think that it's similar to B20. First, when they first put the stress test on, they put it on insured mortgages. And then I think that was in September 16. And then they put the B20 on everybody in January of 2017, I believe. And so I think that they're just really trying to make the market fair and properly competitive, because that's going to be essential in reducing risk against this like renewal wall that people are calling it.
Yeah, I completely agree. Like all those people that bought in 2021 when rates were, 1.5%, if they got a 3-year, they're coming up, or 3 to 5 years, they're renewing now and they're getting that payment shock. And so lenders we're in a position of power. They can kind of strong arm you and kind of give you any kind of rate. And you're kind of forced to go with them because you know that if you were to shop around, that you have to undergo the stress test. And even if you were paying your mortgage up to date and you're not, you don't have a delinquent mortgage, you'll be forced to kind of stay with your lender because you won't pass that stress test. So to me, that makes perfect sense, and I'm glad they did it.
I'm always weary when we change things, and that's just my personality. So for me, it's like, why does a stress test exist? Why do we keep stress tests in? And I get what you both are saying in terms of more competition. But let's just say someone was, almost delinquent, or they have missed a payment. And because of the mortgage kind of freedoms they've had in the past couple of months, because of everything going on in the market, they've talked to their lender. Now they're switching to another one. Like, it's not like they're passing on that information from my understanding. So I'm just weary. I just don't know.
Well, the stress test is in effect because it's adding 2% to the current rate. And since we are in a landscape where interest rates are declining, obviously it's not for sure, it's not guaranteed, but the likelihood that they are going to continue to decline is very high. I think it doesn't make sense to stress test them on it, because what are really the chances that they're going to have to pay 2% more in the coming couple of years, right? And so I'm not really weary. I think it's fair.
Yeah, I think a 2% rate upside scenario would be a pretty scary rebound in inflation in Canada. I mean, it wouldn't be unheard of. We did see that happen in the 70s when we saw a second wave of inflation, which was actually worse than the first one. And that's like that kind of famous era with Volcker from the US Fed, where rates went into the double digits. Not that I think that even if we saw a second wave of inflation, we would ever end up that high. But yeah, I mean, to imagine rates going back up to 200 bips to the upside from where we are today is tough to imagine. But I think that Routledge, who put the stress test in. And honestly, like I really would applaud him for his foresight there, and I think he applauds himself for his foresight as well. He's definitely very proud of that policy. Um, I think that he is likely going to wait until things really, really look clear before making any changes to the stress test on acquisition. With all of that being said, I think the stress test being peeled back on renewals is helpful. It's definitely gonna help alleviate stress on probably the households that are struggling the most against that renewal wall. And what that'll do is it'll have a bit of a positive impact on the real estate market, because it won't it will hold back some of the supply. Like there's probably a lot of people, maybe not a lot, but there's probably some people out there who were looking at their renewal and saying, there's no way I'm going to be able to afford my mortgage at a 5% rate. And so, being able to maybe go to a more competitive lender, maybe actually being able to make that switch from a B lender to an A lender, which a lot of people got limited from by this policy, and got caught in, usually if you buy your place with an A, you plan on refining out if you buy your place with a B or a private, you plan on refining out with a lender at a lower rate after some period of time. A lot of people got stuck in that purchasing in 2020, 2021, 2022, and haven't been able to kind of get out of that hole. So
Dan,
this hopefully will alleviate that. Yeah.
If you're switching from a B lender to A lender, you still don't have to get stress tested?
In the current environment on renewal, there's no, I guess from a B to an A, you would
probably still have to, right?
Yeah, because it would be a new mortgage. Yeah.
But even like the discrepancy,
they're looking at A to A.
Yeah, I think the discrepancy in the rate is probably like 1%, or maybe even 2%. So it might end up working out to switch over to an A anyways and get stress tested. You never know.
Yeah.
Yeah.
So
I guess it would depend. It would depend on the rate environment pricing.
Right. So speaking of all these policy changes, if you could drive policy changes, what policy would you tackle first?
Yeah, it's a good question. I think development charges would probably be the first one on my list. I think that we need to make new housing more affordable, and the only way to, like, I think if you make new housing more affordable, it will do a couple of really impactful things. The first one would be that investor capital will probably flow into new housing, and I know that they're making an attempt to do that with increasing the amortizations on new houses. I know the Globe and Mail put out that was going to apply to investors, but that actually ended up not being true, which was unfortunate, because I actually was like, that would have been a great policy move for them to allow investors to have 30-year AMs on new builds only, so that their cash flow scenario would be better, and it would help investor capital get into that.
Oh, I thought it was for everyone.
No,
I thought there was
no buyers.
But then it was somebody. Okay, so that was the mistake.
Owner occupied. No, it is everyone. Well, like, so they, on the government website, it says everyone, and the Globe and Mail had confirmed with them that it was investors, but I think that they walked it back. But when they say everyone, it's anyone owner occupied. So you can only get the extended amortization in owner occupied
if you're going to live there. Okay.
That was just first time home buyers. That's good to know. If it's owner occupied and you own another home, you could still do it. So that's good to know.
As long as you're going to live there, right? Like if it's your primary residence.
Mm-hmm.
Exactly. So I guess in that regard, like that policy seemed to be aimed at, they call it like almost a supply side measure, even though it's a demand stimulus. So they're trying to get supply created by making it more achievable to purchase new houses. I think that the easiest way to do that is to reduce development charges. I think that like that's something that is incredibly necessary. So that's probably the first thing I would do. And you could even do that at a municipal government level. I think that the first municipality who does start getting competitive on development charges is going to realize the huge economic benefits of that. And like in the GTA, any municipality in the 905 could drop development charges to zero or close to zero, like just have extremely competitive development charges, and all of the developers would move there and start developing product there, because the house prices, like if you assume all of the 905 is a exchangeable product, if you're buying a new house in Oshawa versus Peel versus North York region, or even like the south end of Simcoe, Bradford, if you can price one of those 20% below your competitor because the town that you're building in doesn't have development charges, you're going to have significantly more demand than the product that you're competing with. And that municipality will benefit from all of the buyers who are purchasing going to move in there. And they get this, like, when if somebody's buying a house, it's like the most sticky product from a brand loyalty perspective, if we're calling the brand the municipality, right? This is why Coors Light markets to 20-year-olds and not 40-year-olds, right? And so if you're a municipality and you're going to get a first-time home buyer who's going to have a family there, their kids are going to go to school there, you have them in your town paying taxes for 20, 30, 40 years. And so it's just really surprised me that at a municipal level, no governments have really figured this out and tried to tackle the problem of development charges.
And then they get the housing accelerator fund as well. So it's an added bonus. So if they need like a new city or like something for the city built, they'll get that from the government on top. So
that's for upzoning, yeah, in a lot of cases,
yeah.
If they go to, so like a lot of the cities are getting funding for upzoning to fourplex.
Oh, okay.
So I think that's a great idea too, because it would have a huge ripple effect. More buyers come in, which means there's more supply, and that will start to make homes more affordable, which is great. And even like in the news over the last few months, we heard about this builder coalition that came together and asked the government to bring down development charges, and for every dollar they reduce it for, they pass it on to the buyer. But the government still hasn't responded, from my knowledge. Like, what have you heard about this, and why don't you think the government is taking the builders up on this?
Because I think that the government is probably relying on all of that development charge revenue, even though there isn't any, because nobody can afford to build houses, so they're not making any. But they're relying on that revenue to fund their growth, infrastructure projects, et cetera. There's this notion that growth pays for growth. And most municipalities are going to have a hard time covering their operating budgets, right? So we always think about how interest rates went up and it impacted us as consumers. But in Canada, well, in any country, but in Canada especially, that also dramatically impacts our governments. So Ontario is the most indebted sub-sovereign state in the world. So as yeah.
What?
We have more
In
debt
the
than
world?
any state. Yeah.
Wow.
Yeah. So, and Ontario, one of their primary revenue line items was land transfer tax, right? And so we all know what happened in the real estate market between 2022 and 2023. You would have seen a 60% drop off in total dollar volume of real estate transacted. So they just saw a 60% reduction in one of their biggest revenues, and that's just at a provincial level. City of Toronto has a municipal land transfer tax, and that now they would have had a comparable reduction in revenue there. And at the same time, if people aren't buying pre-construction houses, then the governments aren't buying, aren't getting development charge revenue from those houses being built. And so, I think it's a little bit short-sighted on their part, but I think that they are assuming that if they're going to have operating budget challenges, like the City of Toronto is a good example. They have $6.5 billion sitting in their in the development charge account, which is the I think it's called capital improvements. They're two separate accounts, right? So this is the interesting part. And if a municipality has to declare bankruptcy, which like isn't out of the question, by the way, for a lot of governments in Canada right now. I mean, we heard it with the city during like the reopening and the TTC issues and all of that stuff. Then, the creditor, receiver, whoever it is, would say, hey, what about all that? What about that $6 billion over there? Why don't you use that to pay your operating budget? So it wouldn't surprise me if that was kind of part of the thought process, is we need, to be honest. And it goes without saying that Toronto has probably the worst infrastructure for like a city of this caliber in a world city, and so the other alternative is that they actually spend all of that money and improve the infrastructure of our city, which would be great as well.
100%. Yeah, it's I think I never thought a government can go bankrupt. So I'm just spitting in my head right now about a municipality.
Didn't Greece go bankrupt?
Yeah, I mean, a lot of like states have done it. I mean, basically just their
Their debts are
nations
higher
that
than what
have,
that's coming in.
yeah, I mean, well, pretty much every country in the world is like
Yeah.
that, I think, except for one. I think Liechtenstein, or like, I can't even remember where it is, but maybe, yeah, I don't know. But anyway, I mean, most places are, anybody who can issue their own currency. I mean, like the debt, that's like the concept of the debt ceiling, right? The U.S. obviously has a big benefit because they have the reserve currency of the world. But the idea is that this sort of like modern monetary theory, where like governments who have a currency creation entity, a central bank in their economy, can just continue printing their way out of debt, right?
Yeah, but then look what
The
happens to the world.
Yeah, I mean, that's what we're dealing with right now.
Exactly.
Right? That's why it's like hard assets, and I mean things like gold, Bitcoin, etc. Seem to do exceptionally well because people have utterly lost faith in the monetary system.
So our economy is currently in a slump. Our GDP per capita is on the decline. Like, what are the levers do you think that we can pull as a nation to get out of this slump? And like, even like housing aside, how can we as a country get our GDP per capita to become more of like a prosperous country? And
Yeah.
like our standard of living needs to be restored, right? Because I feel like we've been kind of going backwards over the last couple of years.
Yeah. Yeah, I guess I don't think we've seen any GDP per capita growth since 2016. So if the trend continues and we continue going down into next year, it'll be 10 years of no economic growth. That's basically a lost decade, right? You hear about the lost decade in Japan. That's kind of what they're referring to. Yeah. So like, well, that's what they just went through, right? Like their stock market just hit its highs from like the 90s
Oh, wow.
again. So yeah, the difference is Japan during that period of time had no immigration, right? So it's a really fascinating um, discussion, and the question that you asked is really good. So fundamentally, my answer to the question would be, you said set housing aside. I would say like that is the primary thing that we need to do is set housing aside, follow, or figure out the housing issue. I think a lot of it's resolving itself. Like the free market seems to be doing, DIY density, multi-generational living, et cetera. Like that's where you're seeing that standard of living decline most is, if you think about GDP per capita, the output of GDP is household spending, how much money each household has. And the biggest thing that a household has to spend their money on is housing, right? 30 to 50% of our household income goes to housing. And so where you're going to see the most material impact on that declining GDP per capita is in housing and what people are able to spend. And that's why you're starting to see multiplexes catch on. That's why you're starting to see people buying smaller houses, really downsizing what we're able to afford as individuals in Canada, or as households in Canada. And so we're just kind of going down the same path that New York went through, London went through, in the early 1800s in London. Flats were created from old row houses, townhouses that were cut up into multiple units, right? I think inevitably the Canadian housing economy will start to look like that. So let's assume that that's kind of a big portion of the outcome is, a lot of people think about like demand, like water, right? It's like you're pouring water into a sink and it starts overflowing. Well, the overflowing piece is like the water going from Toronto to Calgary or Halifax, right? That's where the demand is actually liquid. People just going to a more affordable market. But then let's assume it's actually more like mud, or like you're just putting sand into the sink. What happens to all of the demand that's left in Toronto is it just gets packed into the same existing supply. And that's what multiplexing is. That's what roommates are the fastest growing household type in Canada, as an example. And that's where you're seeing that, like you go through any of these new build subdivisions in the 905, there's like 4 cars in the driveway. The whole streets are filled with cars because there's like 4 adults living in a roommate arrangement in a lot of these 4-bedroom houses. So I guess I did say we should set housing aside, and then I went off on housing. I mean, but I think that piece will be like, that's kind of how the solution looks from my perspective. The actual way to fix the economy is we need to diversify it so that our economy isn't so dependent on housing, and dependent from a consumption side. Like we shouldn't depend so much on housing affordability being a driver of our economy, but also we need other sectors. We're the most resource rich country in the world, right? We have the 3rd largest oil reserve in the world. We have a ton of battery metals, commodity metals, lithium brine, et cetera. And so we need to diversify into a resource-based economy. And I think that, to be honest, like based on what I'm modeling for as an investor, what I'm assuming in my investment decisions is that we'll see a regime change, a change in government next year, and that will lead to at least 4 years of diversification of Canada's economy. And so hopefully that will be kind of that us seeing the economy improve a little bit. The last piece, and I know I've been really long with this answer, but the last piece that I'll leave people to think about is there's a Canadian economist named David Card who did a study on something called the Mariel boat lift in Miami, which is basically when a bunch of Cuban people came to Miami when Castro let a bunch of people leave Cuba, and the population of Miami grew by 7% in like a matter of months, and actually had no impact. A lot of people are talking about how mass migration in Canada is deflationary on wages, so it's like reducing wages and creating unemployment and stuff like that. But his study actually determined that it had very little impact on that. But what you see as a long-term outcome of that is especially with like a gray market for labor and a cash labor economy, and now we're seeing the government talk about having international students removed or deported from Canada. I'm imagining a lot of those folks are not going anywhere, right? They're going to stay here. They that's why they came. And I honestly, I think that most of them were promised something that was unfair. And I honestly would applaud their I don't know, or their right to do that. Right. I would say that they have for the people who really felt like they got just let down by the system.
Mm-hmm.
And so, but the point of that whole thing is that the net output of that 10 years later, in a place like Miami or in the US, where you hear about the US has the highest GDP per capita in the world, right? One of the reasons for that is probably because I'm going to guess 10% of their labor force doesn't exist on paper, right? And there's a decent chance that Canada ends up going down the same path in the coming decades. And so I think the combination of those couple of things, introducing new parts of the economy to maximize that new labor force that we just got, and the fact that we still have people who want to join our labor force and come here and work really hard from places where they are willing to work for a much lower wage than Canadians have been historically willing to, should lead to a lot of economic growth for the Canadian economy in the coming decades.
And you mentioned that Canada is a resourceful, rich country, which is so true. We have one of the biggest oil reserves in the world, and yet we continue to export it to the US for them to refine it, which probably logistically might make sense. I'm not really sure. I'm a real estate agent, so I don't really know too much about that. But what I do know is Guyana, in 2015, they found some, like ExxonMobil, I believe, found oil offshore. And prior to 2015, they were never even top 7 in terms of the richest countries in South America. But post 2015, now today they're the richest country in South America, and it's because they're able to grow their GDP per capita using their oil. And it just makes me think, if we are able to use our resources more productively, we can be more prosperous as a nation, and then people will have a better standard of living.
Yeah, I think if there's one thing I would add to that is like the U.S. seems to be better at managing all of our resources, like timber, electricity. Like we buy our own electricity back off of the US as well, right? And that's like something that literally exists on a line. Like it actually loses its value as it crosses the border, because the further you send it, the more it depreciates, let's call it, or it's called line loss.
Why do we do that anyways? Like, is it for political reasons or?
Well, my guess would be honestly that our economy is just so bureaucratic and oligopolistic. So we have like 5 key players, right? Like in you have 5 big banks, you have 3 telcos, telecom companies, 3 ISPs. I mean, you can even see it with and regardless of what you think of Elon Musk, but like Starlink as an example, like the government in Canada is now having a third party look at building a satellite internet service to compete with ISPs in Canada. Yet there already is one out there that could come in and compete very easily, and the CRTC is actually gated where it can operate. So you can get like Starlink, just like you could put it on your car and just go around anywhere in the US, but in Canada you can't because of the CRTC rules. And so they've really just they've enabled more and more anti-competitive behavior in many different economies in Canada, or the segments of the economy in Canada. And so what this leads to is uh, competitive businesses stealing not stealing, winning the business, the refinery, the electric processing, the lumber mills from the Canadian timber, because we just quite simply can't do it because we're so regulated, and we're so oligopolistic. So we have so few key players that are even willing to compete.
Yeah. We should possibly think of like some grants and ways to get it back into our own hands. And this might be, maybe you become a policy reviewer, or maybe you've already advocated, Danielle, for, some of these changes. But I think it's just, I think we have the talent in the country. And of course, we can source the talent out from where else. But unless we start competing for ourselves, our economy is still going to continue to go down this hill. Now, I'm going to ask for 5 more minutes because I feel like we should have made this way longer. But I think
That's okay. I mean, we can take as much time as you need. I got another like half hour if you want. So.
Okay. Our listeners, I know, would want to hear this from you. And if you're okay kind of sharing some of these tips with our listeners, where can you currently find cash flow in the housing market? So where would Daniel Foch be looking?
Yeah.
Because it's difficult.
Yeah. So you can achieve cash flow with some ad value in the province of Ontario. Like, we're seeing deals, I mean, even in like Peterborough, would probably be the closest to the GTA. Hamilton, you're seeing, cash flow on an ad value basis. I think if you're buying a property, or if you already own a property and your land cost basis is pretty low, you've owned it for a couple of years. Like, actually, one of the things that we've been doing is just maximizing existing assets, right? So I have a couple of bungalows in the GTA. We're going to put basement apartments in, add garden suites too, right? I mean, if you go buy one unit to rent out, you got to pay for the land that it's on. Whereas if you already own the land, and you can now add 2 units to that on any lot that you already have in Ontario. So that's probably like if we're saying closest to the GTA, that's really the maximization play, is introducing more revenue to existing assets, existing land. Outside of Ontario, like if you're just in acquisition mode and you are looking for a deal to cash flow, there's a handful of places. I would say Edmonton, most of Saskatoon, or I think all of Saskatoon, you could cash flow at again, you can cash flow anything at a 60-50% loan to value, right? But you go up to that 80% loan to value, which is where most people, 75-80% want to be to maximize leverage. I think you can cash flow in a place like Saskatoon, Edmonton, Calgary, not so much anymore. I'd say Calgary's pretty overbought, or pretty expensive relative to rent. You can cash flow CMHC deals, like MLI Select deals, pretty much anywhere in Canada except for like the Greater Vancouver area and the Greater Toronto area. But again, you're only cash flowing because they're spreading the amortization out over 50 or 55 years. And so your principal payment is basically nothing. You can find cash flow on the East Coast. So like a lot of those markets recoiled after, actually in Quebec is an exceptional market as well. And Quebec's one I'm really watching because, where we're seeing a decline in migration from India, we're seeing an increase in migration from Nigeria, and Nigeria is actually French speaking. Now, Quebec can control their own immigration, so immediate. But once people have PR, they're likely going to go to the place where they can speak the language most simply, and so there's a decent case for, if we see more migration from Africa, the actual most approachable language for people coming from there is French rather than English. And then, the East Coast, I think, is another great example. I think like Moncton, Halifax is a little expensive. St. John's is great. Like we're seeing Newfoundland there's a lot of good deals there. I think as you get east, there's a little bit more tenant friendliness, which is kind of what dissuades some investors. And that's why a lot of people really like the prairies.
Nice.
So anybody that's wants to stay close to the GTA, basically, I think the only city you mentioned was Hamilton, right?
I mean, if you're buying today, but you can like, if you have proper ad value strategy, you could convert to a multiplex in the city of Toronto and get to cash flow, to be honest with you. You just really you gotta buy your land right. You got to be able to keep, be a good project manager and protect your costs on the construction side, and design a good product that rents well. But yeah, I mean, if we're seeing people do 4+1, so they do a fourplex with a garden suite and cash flowing at and that's on CMHC, so it's a little bit different because they extend the amortization out, but it's achievable in the city of Toronto.
And I'll tell you, Daniel, I'm not going to disclose where exactly, but people are also converting their garage spaces into units as well now, and I've seen it firsthand. Yeah,
I've done that, honestly. Like I that was the first garden suite I ever built. I built in a garage and eventually got it permitted. But I mean, I think one of the things that a lot of people are not realizing, and we're starting to realize it now as they try and put policy measures in to regulate landlords, is that a lot of the affordable housing supply is coming from things that take place outside of the building permit environment. And every time they give the market an inch, like they announce, oh, you can fourplex anything in the city of Toronto, people are like, oh, well, I guess I'm just going to go and, not get permits and turn this thing into a fourplex. And not that anybody should do that, but it definitely happens, right?
Brampton is huge on rental regulations right now.
Yeah.
And so they're sending inspectors. People are reporting it. I mean, we have a whole list of legalized basement apartments, so you can even check, to be honest, right, before you rent. And I think most people call it when they start having issues with their landlord, to be honest. But there's actually inspectors that are going through the city right now that are getting fines, everyone.
Yeah. Brampton used to have this grant where the municipality used to give anybody that had a basement apartment that wasn't legalized, they actually gave them a grant to retrofit it so that it would be legal, but they actually removed that grant for some reason, which I think would be great because they want to increase the supply, and would be a great way of doing so, right?
Yeah, I mean, they can also do like tax incremental grants, right? So like they don't actually give you the money, but they just give you a discount on your property tax until you have paid for the value. Like that's a pretty easy way to do. There's so many things municipalities can do. They've just really, to be honest with you, chosen not to, and the reason is because they that we're a country where greater than half of our population owns houses, so you're 66% homeownership rate, and so the easiest thing for them to do is to pander to homeowners, right? And so is if they keep working that homeowner base, then we're always going to have policies that support existing homeowners. And the craziest part is that upzoning actually does support homeowners, but no politician has really figured out a way to communicate that properly to, if I change the output value of your property from 1 unit to 4 units, I've just 4x the development value of your property. And so if you're a homeowner, you should actually be cheering on upzoning, but most people are against it.
Yeah. I think for me, it's as you say, I live in a new development area and there's cars everywhere all the time, all at once. And so when you have kids and they're playing on the street, or even just the garbage smell, when so many people live in a house and they're just constantly putting it in, it becomes an impactful issue.
Yeah, 100%.
Yeah.
I think that the next census is really going to shock Canadians when we realize how much consolidation of households has taken place in the last little bit. And I mean, the math alone shouldn't surprise anybody. It's like, oh, we didn't build enough houses and our population kept growing. And homelessness rose, but it didn't rise that much. So where are all these people? Well, they all got packed into the existing supply.
Yeah.
It's just math.
Exactly.
Well, thank you so much, Dan, for joining us today. Can you let our listeners know how they can connect with you on social media and all that?
Yeah, I am fortunate enough to have a really weird last name. So if you just Google me, usually you'll get the best result. So Daniel Foch, Foch, and just you'll find me on pretty much every platform: TikTok, Instagram, Twitter, YouTube. Now a little bit tough platform, but so I'm happy to interact with people wherever they can find me.
Perfect.
Great.
Thank you so much.
Thank you.
Thank you, guys.
Take care.